The market cap has fallen now below Walmart and JP Morgan. That's stunning in and of itself. If you consider where it started this year.
Tesla shares sliding over 5% today, maybe at 7%, as the automaker heads towards its seventh straight day of losses for the first time since 2018. The latest issue here, Tesla reportedly extending its Christmas holiday shutdown in Shanghai by a day, telling workers there on Saturday to go home. Sources say Tesla is facing a wave of COVID infections that could be why we're seeing that shutdown here today. Also, Reuters reporting today that Tesla is shutting down in January for the Chinese New Year, leaving it only open for 17 days of production. Again, that's more than what they would normally be shutting down for, Shauna. So, I kind of got to say this is more about the drumbeat of demand, of demand falling is dripping. It's happening. It's every day you hear a news story about something going wrong in China for Tesla.
Yeah, certainly. I think a lot of the losses, at least recently, tied to the demand worry, what that looks like heading into the new year. We know we can expect higher rates, which has clearly been a headwind for Tesla. A number of these growth-oriented names, we're looking at losses over the last month alone of nearly 40%, the worst month that Tesla has seen on record. A number of analysts have been starting to sound the alarm just in terms of the concern that they have, obviously, the distraction of Twitter, what that means for Elon Musk, the CEO of Tesla. Dan Ives is out with a new note today saying that the reality is after a Cinderella story demand environment since 2018, Tesla is now facing serious macro and company-specific EV competitive headwinds heading into the new year. He does go on to say that Musk is viewed as, quote, asleep at the wheel from a leadership perspective for Tesla at the time. Investors need a CEO to navigate this Category 5 storm. So I think a lot of investors are scratching their heads a little bit, just wondering what that demand picture is going to look like over the coming months, how quickly Tesla will be able to kind of right the ship, because it has been a clearly challenging several months here for the company.
Yeah, and it's really this double whammy of demand is sort of at an issue here, right? Mm-hmm. Global markets sort of kind of coming down a bit, right? Rates tightening, but then also the negative sentiment for Elon Musk, right? So people don't necessarily want to be seen in a Tesla, supposedly is what people are saying. And if you think about there's a huge amount of replacement of cars having to go from gas powered to EVs. That still needs to happen. And Tesla's really in the driver's seat for that. They are operating at a really remarkable level with their operations. The question is, can they take off the spotlight from Elon Musk, who is sort of commanding that every day? This past weekend, commenting on a Dmitry Medvedev tweet from the president of I believe, president of Russia, talking about how, these vast 2023 predictions is not really where he should be right now. He should be focusing more on the company, and that's what Dan Ives is talking about. Sleep the wheel. We don't need a Ted Stryker. We want an actual captain there. Yeah,
and Cowen was out with a recent note saying that there's a sense out there that the market share has peaked, concerns about over-reliance on China. That's why we're seeing such a drop in the stock today, following the fact that they could be cutting back on production. But then on the more bullish side, you're right, they are such a leader in this space. EVs are the future. Tesla clearly has a wide margin there just in terms of the success that they have already seen within that sector. Canaccord was out with a more recent note saying that they're more positive just in terms of the innovation that is it continues to accelerate at the company, and that's in stark contrast to what we have seen as some of the other larger tech firms. And then they went on to say that, quote, green shoots of recovery may appear in the next year. So even though we have seen significant losses for the stock this year, a number of analysts, Dan Ives also being one of them, still has an outperform rating on that stock because they are confident that the company is going to be able to recover some of those losses in 2023.
Yeah.
We'll see.
And we'll get the Inflation Reduction Act effect for them starting January 1st. So,
right now it hits another new low. The market cap has fallen now below Walmart and JP Morgan. That's stunning in and of itself. If you consider where it started this year, Joe, it was north of $1.2 trillion. Okay? Now it is, as I look at it now, it is like $355 billion. That to me is emblematic of the story of the year in the stock market itself for stocks like that.
Without question. The beginning of the downfall for Tesla was in early April when Elon Musk announced the stake in Twitter. At that point, the stock was 10% higher on the year.
Not 10% higher than where it is now.
10% higher
in the
on
green.
The year. In the green.
For the year.
Subsequent to that, in 4 separate stock sales, Elon Musk has sold $23 billion worth of stock. Now, he's tried to defend the stock. He has split the stock. He has dangled a stock buyback. He has said he will no longer be the CEO of Twitter. He's attempted everything he possibly can. What he cannot do is he cannot defend against the massive ownership that existed in this company. And unfortunately, for those that do own it, the cost of capital has changed so dynamically that ownership is being liquidated in what I think is one of the most dramatic equity liquidations I've witnessed since 2000.
So momentum is a powerful thing.
Powerful.
Up and down. Now, you own the stock.
We do.
Through the Joe T ETF.
Correct.
Now, if I'm a betting man, and sometimes I am a betting man, I'm thinking that when you rebalance, which is coming at the end of the year, and we're going to find out shortly after that what
end
the
of January
current holdings are, that Tesla may not be in the Joe T. Can you give us an idea, if you're able to, on how you're thinking about this right now?
I'm going to give you my best Bill Belichick. I'm on overtime the last day of January.
You're on to Cincinnati, in other words.
Correct.
You're not talking about it now, and it's, I'm sure, because just from a regulatory standpoint, I would imagine that you're not able to get into any sort of key details about that. However, Jenny, how are we supposed to think about what's happening here as it sort of relates to the overall narrative in the stock market? Because I think they're tied together.
I think so. And actually, Scott, as I was driving in, I was listening to the radio, and you said something that was so smart that I texted it to myself so I'd re-quote it. You said, we are re-rating everything because of what lies ahead. And that, to me, that sentence encapsulates everything that's going on. That's Tesla, that's Peloton, which is what I think you were talking about. It's the reason energy is up, it's the reason utilities are up. Everything's being re-rated. It's not all in one direction. It's not all negative. Some of it's quite positive. But when we look at Twitter, when we look at Tesla, where I disagree with Joe a little bit is it wasn't Twitter that created the downfall. It was that the share price never should have been what it was. And that brings me back to that Charlie Munger quote, which I'm going to completely botch, which is something like any wonderful company can be turned into a terrible investment simply by driving up the share price too much. And that's what happened. That's what happened over the past several years. These share prices just got.
You think Twitter had nothing to do?
Twitter was a catalyst that accelerated something that had to happen.
Okay, so if the stock was standing at the edge of the cliff,
something else.
It was Twitter. No, it was Twitter that pushed it over.
No, because
I think you guys can both be right.
I think you're right.
I think you guys can both be right. I think Twitter was the most recent episode to puncture one of the tires, but the car was already in trouble because of where we are, what the Fed is doing, and as I said this morning, what lies ahead still.
I'm sorry, I disagree with both of you. The stock was 10% higher at the beginning of April. The market was already down. There was a degree of resiliency built into the stock.
There was, but only into the stock price. The thing is, it was trading back then at what, like 10 times the collective value of every single automotive company in the world.
Some people think it's a tech company.
Okay, but it just didn't make sense. At some point, the future cash flows need to justify the current valuation. And there was no version of Tesla at its peak that was ever justifiable, not for like 30 years of growth. And so that's what's happening. And that's what happened. It came down. It's just reconciling. The whole year is about reconciliation.
Yeah, I think that's a fine way to put it.
There's one more thing, Scott.
Go ahead, Michael, because if I'd have told you at the beginning of the year when Tesla was in the $1 trillion club with the Microsofts and the Apples, and I said that at the end of the year it was going to be in the Walmart club with a market cap that obviously is respectable. Any company would be respectable to have a $350 billion market cap. But if I'd have told you that it was going to go from 1.24 trillion to 355 billion, you told me I was crazy.
Not me. I would have said you're smart.